Hey everybody, Courtney Smith here with our March 21st edition of Wall Street Winners. And this is our well, you've seen it before. All right. So we got a very strong, we talked about the seasonality and we talked about how this was a possible double bottom and so on and so forth. And it seems like everything I said was true, which means that everything I said was false. But the point is that we are still in a seasonally bullish period that ends in another month. So the market took off, and I'm going to show you why it took off here in just a minute. But obviously the Ukrainian situation is part of this, Fed policy is part of this, et cetera, all the normal types of things. But we just broke through we just failed to make a low. That's called a failure bottom. And we confirmed it on Thursday by breaking through the previous high. So right now, this market should rally up to probably 46, 4,700, something like that over the near term. So we'll watch that closely. Another big change is, for the first time since the middle of January, we had more buying pressure than selling pressure. That's even the rally that we had in early February, late January, didn't have more buying pressure than selling pressure. So this is a big change in the market as well. NASDAQ, same story. Really, it's now running in parallel with the S&P. The seasonality, we're still in a seasonally bullish period, but you know, my buy point is way up there. Maybe I should move it down. I'm not sure. Down in the utilities, they start bullish period on May 1st, so we're still a ways away from that. We got up to the old highs, and we're kind of failing a little bit here on the Utes. Now, right here, you can see we're in the middle of a rally period. Look at I think the one that works the best is the red and the purple lines. They're basically the same. So a continuation of this little rally, then another dip in the market, and that should probably start this week. And then we should finish up a rally, which is shocking everybody, up towards the end of April. So that, I think we're following the seasonality very, very closely. And it's just a matter of the degree that we're following it that is different. Now, this is the big reason that really, really amazing movement in asset allocation. People just sold bonds like crazy. I mean, they basically just said, you know what, we give up on the bond market. Now, why are they giving up on the bond market? Is because they're losing money. So they sit there and say, well, let's see, I'm getting 2% on a 10-year note, and I'm losing money. I don't really want to hang on to it for 10 years, you know, because interest rates are going up. I mean, if I bought these 10 years a year from now, they might yield 3 or 4%. So you know what I'm going to do is I'm going to bail out and go get 3% from General Motors or some stock like that, or a preferred, and get 5, 6, 7% on General Motors. So they're basically saying stock market's okay and bonds suck. I don't get enough yield and I'm losing money. Let me bail out. Let me go buy stocks. And when we look at the risk-taker, though, they're starting to take a little more risk. That's why the NASDAQ is starting to do a little bit better. Global shares, like Ukraine, where's that? Oh, we forgot. So now they're starting to rally. Yield curve took off. We just said bonds hammered, which means yields are up, which means that the yield curve is getting more positive. But wait. Look at the chart in the lower left-hand corner. It's flat, except for the first 2 years where it's very, very positive. But 2 years out to 30 years, that thing's flat. So this makes interpretation a little hard because technically there's two yield curves that people look at the most. I like the 90-day 10-year, which is what's graphed on here. But another very popular one is what's called 2s, 10s, the 2-year yield versus the 10-year yield. That's flat, but the 90-day to 10-year is still very positive. So it makes it a little bit hard to look at, but you kind of have to look at both of them. Now, we know that the Fed's on an increasing interest rate environment. They say they're going to be up around 2.5% in the next year, which is why the 2-year yield is already there. They know that's going to happen, so they've already moved it there. So what we're going to see then is that if the Fed moves up to, let's say, 2.25, 2.5, something like that, the yield curve is going to be very, very flat, and that's going to trigger a recession. Now, that might take a year. So we may not see a recession this year. We're going to see a lot of slowing in the economy. That's a done deal. That's a done deal. But when we have a recession and a real bear market, as in 30%, that might be next year, not this year. That might be next year. But we'll keep an eye on it, and we'll let you know exactly when it's going to be way in advance. So bonds collapsed, but then they've stabilized a little bit here. Notice the heavy volume. Amazing. Bond key factors, all of them screaming to higher yields. Complete unanimity on all the indicators are all saying higher yields. So our indicators say higher yields, got to sell bonds. Dollar staggering around here, not much going on there. Gold, higher interest rates, not good for the gold market. So we've got gold going down. And I think gold, if we look at all commodity prices and include gold in that, they all have roughly, I mean, this looks like the chart of crude oil. Let's just put it that way. So they're all coming down. We're not going to go into a new bear market, but what we're going to do is we're going to stagger for a while. We're going to rock and roll and stagger and make a stab at the highs and make a stab at the lows. This is going to be a mess with high volatility for several months. So I'm not that interested in owning gold. Our gold key indicators, 2 neutrally and 1 is dying. Crude oil, see, that looks just like the gold chart. I'm saying the same thing. I'm currently in the United Arab Emirates. So, of course, we have tremendous crude oil knowledge here. Daily newspapers cover the crude oil market very well. And I think as I say, we're just going to stagger here for a while. Let me go back. Notice that we're seeing a big decline in volume. Big decline in volumes, which is actually bullish. So we had high volume in the bull market, low volume on the decline. We could see the market move back up again. It's not going to make new highs, though. That's not going to happen. We've choked off demand too much. And Bitcoin's just following the stock market, only in a muted way. I'm a bit bullish here. As our 55-day high has come down, I'm getting ready to put in a new buy order here on Bitcoin. Okay, freebies, you know, I don't have to say it anymore, do I? But really, come on. The cool kids, we saved a seat for you. Come and sign up. Bye-bye.